Hello and welcome to this trades and tutorials video. This is Jeff Bish, president of MarketGauge.com. And in this video, I am going to take a look at a line in the sand that the IWM, the Russell 2000 market, has bumped up against. This is an area or a level that I don't hear anybody talking about, and it's much more important, in my opinion, than the S&P is pulling back down to their 50. And it also really explains why, if you've been having trouble finding stocks to buy and have them continue their trend higher, it's been rough. So before I get into all that, let me just make sure that if you're just finding us on YouTube for the first time, please like and subscribe. And as well, know that you can find more videos and insights like this over at our site, marketgauge.com/tutorials. You'll also find us on Twitter at MarketGauge and at Market Minute. And if you're not watching this in HD, click on the settings window or the settings button in the lower right hand corner. All right, so back to the Russell 2000. So the thing that brought this to my attention was this little table that we have on our site. It's free. It's at the market overview section of Little Big View. And to get there, you would just go to Little Big View, blogs and tutorials, blogs and free tools. And the thing that really should jump out at you in this table is the fact that year to date, the IWMs went negative. All right, now this is from the 22nd close, and we're trading up a little today on the 23rd, but this is really a big picture. This is the line in the sand, as I described it earlier, that we really should be watching. All right, now if we take a look at this same concept, and the concept is basically that when you have a market that's up on the year, you want to pay extra attention to sectors or to indices that make a new low on the year, and even more important, if it's negative, right? So IWM is going to be down on the year and a new low for the year if it breaks through its recent lows. That is an incredibly bearish, I don't want to scream top here, but it's an incredibly bearish development. And if we see the others start to follow suit, then this is something you want to pay attention to. Now we'll take a look at the charts in a second, but before I do that, you can do the same thing with the sector summary page. So I just clicked on sector summary, and we really should be keeping an eye on this year-to-date column for the reasons that I've just described. Now, I did a webinar with Mish last Thursday, and we talked about two sectors that were really important and were at important trading levels. One of them was IYT, and the other one was KRE, which here we have the XLFs, right? Financials. Now I'm going to take a look at the charts in a second, but IYT also just starting to be down on the year. Now, it's no coincidence that the sectors that really have been lagging this year are down on the year. They've been down on the year for most of the year. They just can't seem to get out of the soup. So as I said earlier, when a index sector goes from being up on the year to being down on the year, and not only down on the year, but a new low for the year, that is a big bearish heads up. Now, from the bullish side of things, we don't have a lot of sectors doing that. But the other day, the market got hit pretty hard, right? So let's just take a quick look at the general markets, and we'll see here the SPYs in the upper left-hand corner. This is the 50-day moving average. So they've just come down to the 50-day moving average, and the natural question is, is this likely to hold? Well, the IWMs in the lower left here, you can see already broke their 50-day moving average. They got hit pretty hard too. But the low for the year is this level right in here. All right. So like I said, people may be focused on this level because it's been a support level, but the fact that it is a new low for the year is significant. So if we take that out, you really want to be cautious about betting on whether or not the SPYs are going to hold the 50. If we continue to bounce, then we can focus on the SPYs as having a good shot, and the Qs as having a good shot. All right. So step one or part one of this video is focus on that IWM level. Now, the next thing is let's take a look at those two sectors that we were talking about, or I said we were talking about in Mish's webinar. And the point of Mish's webinar was that you can look at phases and use the phases to determine the overall direction of the market. And the fact that IWM was trading right around its 50-day moving average, which is this blue line in here, and that's a line that determines whether you're in a bullish or bearish phase or any of the other 6 phases. So coming through that line, coming through that level is negative from a phase point of view, but you can also see down here, I have an indicator which we call one of our triple play indicators. And this indicator I'm going to be talking about in a webinar tonight. If you're interested in it, I'll put a link under this video. And this indicator tells us whether or not the particular market, stock, sector is a leader or it's a lagging or leading on the downside. And so in order to be bullish, you want the blue line to be over the red line, and even more so the red line over the black line. So you can read it just like you would read moving averages. And so in this case, you can see here, IWM is bullish. It really has a strong run, but look how IWM has acted ever since this high, right? Ever since this high, the blue line has not been able to get over the red line, so that is a bearish indication. Even when the IWM was trying to break out to new highs, it could not get its momentum, it could not get its leadership power over that red line. That's a bearish situation. So it's no surprise that it got hit pretty hard once the momentum started heading on the downside. Now, this is another reason to be a little concerned about IWM right now, which gets magnified again if we break that level. Now, let's take a look at the two indexes that Mish highlighted from a phase point of view. So in the webinar, the conversation was KREs sitting right on the phase. Be very careful if they break the 50-day moving average, because that would represent a phase change, and the first time it's really done that since down here. Now, what we didn't show you on the webinar, because the triple play was not part of the phase presentation, is that the triple play was also screaming, don't be a buyer on weakness here, right? You can see down here, you've got the blue line under the red line. And just like IWM, even when the KREs made a new high and they immediately retraced, when they immediately retraced, the blue line went under the red line. That is not how a strong market should act. All right. If you look at the opposite situation here, where the KREs pull back to the 50 and they rally up, you can see the blue line rallies right up with it. When they pull back to the 50, the blue line holds. When the market pulls back to the 50 again, the blue line doesn't just hold, it's well above. So this is a bullish situation and the market takes off. This is a bearish situation and the market gets completely clocked. All right. Now, the other reason I focus on KRE is because KRE had been one of the leaders. The financials had been a leading argument for this market, and that seems to have shifted. Now, if we take a look at IYT, it's the same story. All right. And that story is it pulls back to the 50-day moving average, but when it does that, look at where your triple play leadership line is. Bearish. All right. So when you have a market that pulls back to the 50 and you have a bearish triple play, especially if it's a bearish triple play that's been developing for some time, you want to be out of the way. All right. So this is just two kind of legs of the market that really the market needs to hold up and continue higher. And they're not only are they weak on the surface, but they're weak in this trend, which I would refer to as the invisible trend that you just can't see in normal charts, right? Again, if we go back and look at how it lined up when it came to the 50-day moving average before the election, this was actually bullish. It was bullish on top of this moving average. Here, when it was on top of the moving average, it was bearish. All right. So if you'd like to learn more about the triple play, like I said, I'm going to do a webinar to show you how it can be used. And imagine how powerful this is when you can identify which stocks, which can move even more than sectors. And there's also a volume line, which I'm not didn't get into in this video right now. So it's really powerful. These are trends that, unfortunately, I bring them to your attention to let you know that there are some serious cracks in this market. And if the market starts to head lower, don't be too eager to jump right in. If it turns back up, well, if you've got triple play, you'll know which ones to get in. But you got to be careful not to be in the stocks that are really weak underneath, even though they may look like they're just pulling back to major support. So I hope that helps. And don't forget, you can get a lot of the information I showed you here, the sector table and the overview table. This is all free at blogs and free tools on our site. Go to Little Big View and enjoy. And like I said, keep an eye on that year-to-date column. It's a big, big number.